Hello and welcome to Late Night Stocks. Today's topic is Chinese stocks such as Alibaba and Xiaomi. In addition to this, some macroeconomic and political impacts on these stocks. Wall Street is talking about Alibaba and I thought this topic would be interesting for the investors. Recent price jumps made this stock again attractive for some investors, but is it a good time to buy this stock now? Is the sell-off over? What are the risks and advantages of holding these stocks? I will try to explain the situation from our point of view. After that, we're gonna analyze the Xiaomi stock and the latest news about it. By the way, we have a late night stocks portfolio where you can get more detailed numbers and comparisons about companies. You can find the link down below the video. Please give a like to support our channel and would be great if you subscribe us. Let's begin. After a major sell-off phase, Alibaba shares were 10% up on Thursday and continued to increase on Friday. The stock price was under the $140 last month, which is the same level as in 2016. The company has $437 billion market cap, which can be considered basically as China version of Amazon. When we look at the Amazon, we see $1.6 trillion market cap and a P ratio of 57. The question is, why Alibaba is so cheap? Is it really a strong buy? In order to answer these questions, a fundamental analysis of Alibaba is unavoidable. By the way, I compared Alibaba and Amazon in a previous video which you can find in our channel. Alibaba has a good track record and increased its revenue year over year. Last year the revenue was slightly more than $500 billion, which was 20% more than the current market cap. Q1 2021 was not a great quarter for the company and Alibaba was hit with a record antitrust fine of more than $3.6 billion for supposedly abusing its market dominance. This fine was the beginning of the China tech crackdown. A lot of foreign investors sold their shares and closed their positions. So let's continue with the company numbers. The company has a P ratio of 19 and will become 15 because analysts are expecting more EPS in the upcoming period. The profit margin was 19%, which is relatively high for the retailer or B2B. Another important metric is the growth rate. The company had 32% quarterly revenue growth year over year. Its balance sheet is also very strong. The company had $483 billion cash and $181 billion debt. Basically, they had $200 billion net cash position, which is a huge number. That's why $3.6 billion fine can change the financial health of the company. The fundamentals of the company are actually great. Alibaba is growing and investing in booming sectors like self-driving and AI. So far so good. Let's continue with the latest news and try to figure out why we saw such a stock price jumps in last week. Charlie Munger's firm Daily Journal doubled down on Alibaba investment. Charlie Munger is the chairman and bought Alibaba shares at the beginning of this year. He probably thought instead of making stop loss and closing its position on Alibaba, bought more shares because the company is growing and nothing has changed in the fundamentals. Warren Buffett and Charlie Munger are, as you know, legendary investors. The purchase got lots of attention from the Wall Street and some positive news from the US-China relations, such as Biden-Harris administration's new approach to the US-China trade relationship and the US and China president's virtual meeting before year's end made a positive impact on the stock price. When we are back to the chart, the stock price was $161, which is above the 50-day moving average. If the stock can break 200-day moving average, can probably hit 52-week high again. Investors should keep track of the news because the stock price is highly driven by the US-China politics, as I previously mentioned. We have to keep our eyes on the macroeconomics to partly understand the stock market behavior. Inflation and rising oil prices concerning a lot of investors. Gross domestic product is an important metric and it is total monetary or market value of all finished goods and services produced within a country's borders in a specific time period. When we look at the chart, the red line indicates GDP growth and the blue line 10-year treasury note. Such a big jump we can see in the past, and generally GDP growth and the treasury note was parallel. The tapering is coming, but the most important question is when. The GDP growth has two reasons. One of them is increasing demand, and other reason is rising shipping and raw material costs. Next year will be tough for some sectors, especially for the growth stocks. High interest rates will reduce profit margins and increase borrowing costs. For Alibaba, with 400 billion cash, won't be a problem, but we can see sharp declines in the stock market. Another risk factor is Evergrande collapse dangers. Recently, Australia's Reserve Bank has warned that the collapse of Chinese property giant Evergrande Group could cause chaos in the Chinese financial system. If we summarize risk for Alibaba, we have the major two categories. Inside the US, trade war and inflation concerns. Outside of the US, China tech crackdown, and recently Evergrande collapse dangers. If we want to hold Alibaba for a long period and already accepted the sudden stock price drops, as you should look for some more other secure positions in stock or bond market. Before we talk about another tech company, Xiaomi Corporation, I would like to remind you that you can buy us a coffee if you appreciate our effort. Thanks. We analyzed the company in detail in our first video and compared it with Apple. The company provides hardware, software and internet services in mainland China, India, Europe and internationally. It operates through smartphones, IoT and lifestyle products, internet services and some other segments. We can look at first the balance sheet and income statements and then we evaluate the news. The company is consistently growing and had 526 billion Hong Kong dollars market cap on Friday. This corresponds to 67 billion US dollars market cap. The revenues are increasing year over year and the company made 307 billion Hong Kong dollars revenue in the trailing 12 months. As you see, the price to sales ratio is less than 2 and the forward P ratio is 17. As we saw from the Alibaba, Xiaomi has also more cash than its debt. They had 71 billion Hong Kong dollars net cash, and this makes the company more stable and secure investment in the future. Xiaomi becomes the market leader in some regions such as in Central and Eastern Europe's 5G smartphone market. According to reports, the company will remain the 5G smartphone shipment leader next year in this region. As you see from the chart, Xiaomi doubled its market share in just less than 2 years and reached 16%. This is good news, but it reduces the profit margins because of the competition in the market, which is expecting to grow compound annual growth rate of 1.7 in the next 5 years. If we compare this growth rate with other industries, it's not growing and maybe better to say saturated. That's why Apple and Xiaomi try to enter other markets such as automotive. The company plans to launch its Apple Car rival in 2024. The timing is not bad if they can do it. Tech companies who just want to stay in the one industry or market will end up in tragic collapse in the future. Today, hardware and software play a more and more important role in the automotive. Xiaomi had great success in this area and will become successful in the automotive. If we summarize what we said about Xiaomi, the company has good fundamentals like Alibaba. It's profitable and has lots of cash. The realistic danger exists if US-China trade war continues because Xiaomi gets also market share from Apple. The company is cheap and stable. If they can build a better brand recognition and increase their profit margins, this stock can be a 10-bagger. Please do your own research before investing. I wish you a pleasant week. Thanks for watching till the end. Please give a like and don't forget to subscribe. Bye bye.